welcome all. I'd like to thank you all for coming tonight. We are heading into some uncertain times in the property market, and all the people on the Lower North Shore always seem to be very interested in what we're doing or where we're at. So on behalf of my team, my name's Richard Harding, and as I said, I'd like to thank you for all coming in tonight. One of the questions that I get asked regularly is, what's the real estate market like? It's a pretty big market. One bedders through the waterfronts. It's definitely a diverse market that we see on the Lower North Shore, and I'll talk about that, and tonight will be around the Lower North Shore. But my answer generally is the real estate market has been good since 1996. The market from that period on has topped and tailed, but overall the Sydney property market has been extremely buoyant. And I think Nerida tonight, who will be coming on after me, will sort of hopefully say the same thing over the last 30 years. So I read the Sydney Morning Herald this morning. I'm not sure how many of you read the Herald, but I read the Herald and it said there had been 10 downturns in the past 4 decades. Most of those downturns have lasted between 6 and 12 months, 7 out of the 10. The other 3 have gone on another year, but most downturns seem to turn fairly quickly, which led me to think around what has happened in the last quarter on the Lower North Shore. And these are real numbers, but I can't sort of say they're 100% accurate yet. But what we have seen is probably a correction of between 5 and 10% occurring across property prices in the last April, May, June of this year. As I say, it's a hard number to accurately pinpoint just yet, and we'll probably look back and Nerida in another quarter will say this is what it did happen and be able to hopefully justify those numbers. It's also on the back of a 40% rise in the last 5 years, a massive boom that the property market has experienced on the Lower North Shore. So I suppose we have to have some bad with a lot of good in that period of time. I also want to cover what our business actually does in the property market. Our business here, we have offices in Crow's Nest, Camaray and Willoughby. We cover the residential sales market. We manage a lot of residential properties across all those areas. We have a commercial and retail business that does a lot of leasing, managing commercial properties and sales. And for an example, in the last quarter, we leased 2 businesses on the Lower North Shore. 31 businesses took premises. So people still have confidence to go out and start businesses right now. That's a good indicator for us. We also do project marketing, or we have a projects team that does site sales, project marketing, and also if you're in Balmoral or Mossman right now, you would have heard this word LMR, low, medium, rise property development. The state government has brought policy in to build more houses. It's quite confusing. The local council in Mossman last week had a meeting to say they were going to do it their way. So there's a lot of things happening, especially around this Lower North Shore market in growth of what those projects are going to look like and the housing side of the market. We also, in the business, have a loan market business. This is a mortgage business, which I'll touch on a few of the things that have happened in that market coming up, but we also see people lending money and what the capacities and different things that are happening in that side of the real estate market. So we're covering a fair range of properties. We have a business called Urban Living, which does apartment sales only. They only specialise in strata buildings. So we're seeing a lot of different change in that area as well right now. What we've also seen, and I think most of you would have seen, there has been 3 interest rate rises this year. There's a war happening in Iran. There's a lot of negativity around the federal budget in May. Inflation on the rise. So there's a lot of things happening right now, and this is creating very low confidence, what we are seeing in the market. And a real uncertainty across most areas. What we look at though in our business here is we look at where does our market come from, and our market generally comes from the city. So the banking, finance industries, business owners, people doing well, and if you follow the stock markets are still at all-time highs. So we are fueled by what happens in that market, but at the moment, the property market is having a little bit of a beat up. So, and a lot of that comes out, I believe, from the press. If you turn on anywhere at the moment, you see that they're having a crack. The other thing that we look at is job security. So I talk to a lot of different recruiters in the high end of the business market in the city. And when they're recruiting high-end people, we tend to have high-end houses sold 6 months later because incomes go up and people start to buy. Interesting enough though, those markets are still really buoyant right now. We haven't seen the correction in those yet. So it'll be good to see what does happen. On the ground here, on the Lower North Shore, there's about circa 70% of people own their principal residence, family homes. We're very family orientated on the Lower North Shore. So when we look at that number and we start to talk, our third speaker tonight, Stephan Ryan, will talk about capital gains and negative gearing, which doesn't affect your principal residence. So if we look at that on the Lower North Shore, we're pretty well insulated where we're at. And the levels of borrowing are not normally at first home buyer levels that the government bought out at 95% in October last year, or 5% deposits. So the Lower North Shore's a different market to what you'll see across the media. And I'll come up with some fun facts later about different things that are happening. So as the market does have what they call a downturn or a correction, is that a good time to buy? If the markets come off, we would look at that and say it's an optimum time to upgrade your principal residence. You don't have to worry in the past 5 years when the market has been on the increase, the FOMO of the fear of missing out in the market. As long as you make one thing for yourself is to sell before you buy. In a rising market, you can buy before you sell, and you tend to sell your own property and you get to buy what you want. In a market that is coming off, if you buy first, you can be held holding 2 properties, which can be very detrimental to your end wealth creation. So again, the markets of 5 kilometres to 10 kilometre circle around the city tend to have the strongest capital growth over the last 30 years. So in our market here, I've got to say that we're pretty confident that we'll bounce back a little bit quicker than other markets that we're seeing. Just a few things. May, if I look at May right now, it was an extremely weak month. Nothing happened in May. There was real uncertainty everywhere across our market. June bounced straight back. It was a great month. We did as much in this June as what we did last June. So it sort of all bounced back. Now a lot of people say to me, what's happening in July? And it's school holidays, everyone's in Europe, nothing's happening. There's no stock on the market, and that's a tradition. Last year, horrible as well. This year, there's no trade. So the media is on that bandwagon telling us that there's a problem with the market. There's no stock. Well, that's just traditionally middle of winter, no stock. So construction costs are an all-time high. People who are looking to renovate, people looking to build. What we're seeing in the strata areas, if you own strata units, everything's costing more. So if you're getting your lawns mowed, if you're getting garbage taken out, everything's risen. So your strata levies go up, building costs go up, maintenance costs go up. All of those things are rising right now on a daily basis, that what we're seeing people are experiencing. We are, on a positive note, seeing a lot of people getting ready to sell in August and September. Again, a more traditional spring market. Sun comes out. We don't need more warm temperature. I don't think there's any snow, so I was just talking to someone. And we are seeing that there's going to be more stock coming on the market, which will then see movement and trade starting to happen in the market. A quick case study I wanted to run over with everyone. A sale that happened in May, June. We started a property in this area, I won't say which one. We were hoping to get 4 million for this property. We had it on the market for 2 weeks. We had nothing, not one buyer, not any interest at all. The owner needed to sell. They wanted to sell that house right now and then on the market at that time. We actually adjusted the price to 3.6 to 3.8. We found a buyer. That buyer offered 3.7 million. Over a negotiation, in our business, we have to ring every single buyer. We follow up every single contract holder. We found another buyer as well. That property ended up selling for well over 4.2 million. So you go fishing in a pond at 4 million and then there's nobody. At 3.6 to 3.8, the owner was selling it at 3.7. It was on the market ready to be sold and it ended up selling for well over 4.2. So it becomes very difficult for us as well to judge where is the market. So it's not always equal and fair on what happens. I'd like to bring up just some fun facts that I pulled together, just as interest's sake, that I'll get up on the screen here. On the Lower North Shore, this is a circa number. Investors make up about 30%, and that sort of tails in. Most people who invest on the Lower North Shore already have a principal residence. Most of our investors that we manage properties for own properties already that they live in. So there's about 30% of that market that we have. In the last quarter, we leased 124 properties. The rental vacancy, April, our vacancy rate was at 1.3%. May went up to 1.6%. And by June, we hit 2.5%. So the market, we could see in the rental market was starting to change, especially in those vacancy rates. The Lower North Shore residential market has grown, as I said earlier, by about 40% in the last 5 years. Currently, in the last quarter, residential clearance rates in the last quarter have been between 40 and 60%. This is also difficult because we source data from everywhere. Nerida, who'll talk, is a great form of data for us through the Ray White network. But realestate.com, domain.com give us 2 separate clearance rates every week. So as consumers, you look at that and you go, well, what's right? Is it 48% or is it 42%? We then see Ray White data across Ray White auctions and we say, wow, we're clearing it between 60 and sometimes up to 70% in the last quarter. So where you're getting your data and what's happening can also be what sort of houses are being sold or properties are being sold. House prices, we believe, have corrected between 5 to 10%. And I did write in there, is this an opportunity? Or do we all stay uncertain? Commercial rental markets, the auction clearance rates on commercial property and rental and retail property has been between 40 and 50%, probably down from about 70 to 85% in the last 12 months. Mortgage loans, this is an interesting one, were down 30% in the quarter. So the amount of loans we were doing were down 30%, but the number of investors dropped off by 50%. So, and these are real numbers from our mortgage broker of what we're dealing with and what we're doing. Most negatively geared properties will become positively geared within 5 years. So people buy a property with a loan, and within that 5-year period, they'll turn that loan into a positively geared property that is no longer negatively geared. So when we talk about the budget that Stephan can talk about, once you're positively geared, you can't negatively gear. So that's an interesting thing. The other thing that I found really fascinating, because I listened to, at the bottom there, if you are interested in property and you like Mark Boris, Tim Lawless, he's another guy that collects data and talks about the property market. The Perth market has grown by 90% in the last 5 years. So if you were smart enough to get in 5 years ago, you've done extremely well. But I think that market will start to deteriorate fast as well, and maybe Nerida can tell us about that. So I'd like to, again, on behalf of our entire team, we're here to help, we're here to assist. Whatever we can do, we try and get a full coverage of what the market is and where we're going. I want to not be fearful about this market. I want to be more positive that it can lead to other opportunities. So without further ado, I would like to welcome Nerida, who is the Chief Auctioneer for Ray White. Nerida, you will see Nerida a lot on TV now. She's a bit of a superstar because she gets such good data. She's been in the markets for 20 years and she knows what she's talking about.
Great.
Welcome.
Thank you. I don't know if I should turn it on because it seems to be awful. Okay, does that... No, it's a bit too much feedback, I think. All right. I'm going to try and talk loudly, so hopefully everyone can hear me. I'm actually an economist, not an auctioneer.
Oh.
So I thought I'd set that straight in case you thought
Sorry, Nerida.
Different qualification. So today I'm going to give you a bit of an update on what's happening in the market. It has been an interesting market. It's a very hard one to try and judge exactly what's happening. So today, with the way I'm going to structure it, I'm going to talk what's been happening over the past 12 months. I'll do a bit of around the grounds and talk about what's happening in Perth, because Perth is fascinating. I'm then going to talk about some of the really recent data that we're seeing. So the really recent data that we get daily now is our open for inspection data. So if you've been to a Ray White open home, you've possibly checked into that open home. We collect that data. We don't look at who's checking in. We look at the numbers of people that are attending open homes. So we're tracking around 13,000 open homes per week. So it is giving us a really good idea as to what's happening with buyer activity. I'm then going to run through some of the data around pricing. There is some early data that's starting to come through. A lot of it's very variable depending on which data provider you're using. And then I'm going to talk through the outlook, because obviously that is the most important in terms of how we all make decisions. So starting, this is not working. Here we go. All right. Okay. So I'm just going to start with a bit of a summary as to what's happening. I guess the first point is that the market is in a very heightened state of uncertainty, and that's playing out in terms of people's decision making, where they're looking to invest, where they're looking to buy. It's also playing out into the way whether people are selling. So a lot of people are holding back, they're really just watching and waiting, and obviously that has implications on pricing. The interest rate outlook is shifting, constantly shifting. Last week we thought the Middle East conflict was over. Now it seems to be back on again. That's flowing through to inflation. We're now hearing some economists are saying there will be another rate rise. Markets are predicting no more rate rises. I think for now, though, we can be pretty certain there's no cuts in the immediate horizon. So maybe next year, but at this point, no cuts. The federal budget has been a big shock to the property industry. In terms of leading up to the budget, we did expect capital gains to be adjusted. It was only the Sunday before the budget that we realised that negative gearing was also on the table. So obviously that has huge implications for investors. We know many investors rely on negative gearing. It also has implications for the market. But overall, once we start to get through this high levels of uncertainty, we do expect it to impact the more affordable markets. not the more expensive markets like we're in here today. The reason being is that most investors do invest in properties priced under $750,000. So we do see a withdrawal of activity in that price point. Obviously, will impact those cheaper markets. It certainly won't impact Mossman in the same way that it will impact, say, Melbourne CBD apartments, for example. And then finally, when we have a look at the last 12 months, Sydney affordable property has been outpacing more expensive markets. We've seen that very clearly. We've seen it in every city. It has been buoyed by the 5% deposit scheme in particular, has brought forward a lot of first home buyer activity. We do think that that will start to switch. So with investors pulling back, we think cheaper markets will underperform. More expensive markets will probably still be quite slow, at least until we see rates being cut. But will probably do better than the cheaper markets. So a switch in behaviour compared to what we've seen over the past year. So starting with house prices around the country, and hopefully you can see that because what we have been seeing, and what we have seen over the past 12 months is pretty similar to what we're seeing now. We're still continuing to see markets like Perth, Adelaide and Southeast Queensland perform relatively well. They've become very, very expensive over the past 5 years. Compare that to a market like Melbourne, which has been slow for 5 years. Sydney as well, which has also been relatively slow compared to those faster growth markets. Probably the defining feature in these markets and why some have performed better than others, partly it is economic growth. We know that Victoria in particular has had a pretty tough time in their economy. But markets like Melbourne are very good at building, and they have been building far more homes than they realistically need. Move to markets like Southeast Queensland, Brisbane, Gold Coast, Sunshine Coast, we just haven't seen that level of construction keep up with the amount of population growth. A very similar trend to what we're seeing in Perth as well, that we have seen a lot of people moving there. There's been lots of jobs growth, and at the same time they have really struggled to build enough homes. So fundamentally, that seems to be one of the main drivers. There are other factors. I mean, Perth saw no growth for about 15 years before it really took off. Markets like Gold Coast do seem to be incredibly popular with people at the moment. There are a lot of people that are wanting to be there. Some of the interesting things, though, I think to note, Gold Coast median is starting to reach, or starting to almost get to Sydney's median, which, again, I wouldn't have expected 5 years ago. The median is sitting at 1.43 million. Sydney's at 1.67 million. So is that houses only? That's houses. Yeah, actually, units are more expensive. I'll show you in a sec. And then we've got markets like Perth, Adelaide and Brisbane, which now are exceeding Melbourne. So again, there's been quite a significant reordering in the performance of markets over the past 5 years. Units are a little bit different, but I think the really interesting one, again, is just looking at how expensive many of the unit markets have become in the smaller cities. Obviously, Sydney does have a relatively high median for units. It is pulled down by the fact that we do see a lot of cheaper unit development in middle and outer suburbs. But now Gold Coast, Sunshine Coast and Brisbane are now seeing unit markets, their unit medians exceeding Sydney. So again, something that we didn't really expect to happen. In the unit market, in many of these unit markets, we are seeing them outperforming housing markets. And again, it's surprising. We typically long term, we do see housing markets outperform unit markets. But that is really being driven by the 5% deposit scheme. So there has been a lot of first home buyers that have moved out of houses, which they would have typically bought in markets like Brisbane and Perth, and gone into the unit market. So that's really elevated those costs. The other thing, though, that has been really driving unit markets is the fact that it is really expensive to build now. And when we have a look at what developers can build, it does tend to be luxury, because those buyers of luxury apartments tend to be less cost conscious than more affordable apartments. So that's also been something that's been pushing up the median. So that was then. We're now in this quite different environment. And I mentioned before our open home data. So hopefully you can see that. But basically what it's tracking The light blue line is 2024, so looking at open home data over every month. The black line is 2025, and the yellow line, which has really fallen as we've moved into July, has hit a level that we've never seen before. So when we have a look at the number of people visiting open homes in Sydney, it's at around 1.9. So roughly 1.9 people per open home is one of the lowest levels that we've seen. So it hasn't hit zero. So, obviously there are still people out there looking to buy, but it is a very, very low rate. So we can clearly see that for buyers in particular, they are very, very cautious at the moment, and they are watching and waiting. And that's one of the biggest factors which is pushing pricing down across Sydney. I suppose one other thing, though, that is a little bit positive, though, is we have seen a bit of a stabilisation in recent weeks. So I think everyone who's watching data is watching a lot of things. One of them is auction clearance rates. They've started to stabilise, and the other one that's stabilised is open home data, but it is still very, very low at this point. In terms of what's happened to pricing over the past couple of months, it is hard to tell. So I know Richard was saying, 5 to 10% potentially in Mossman. That seems high to me, but again, we'll probably get a better idea over the next sort of 3 to 4 months as we get more data coming through. But when we have a look at the different data providers, all of them are now saying that Sydney is clearly in downturn. So Cotality is one of the main data providers. They've now said prices have fallen by, what are they saying over there? So prices have fallen by about 1% over the past couple of months. PropTrack is another one, so that's realestate.com.au. So they're also saying that prices have fallen by about 1% in Sydney. So it's not a lot, but I guess, the worry is that things will continue to deteriorate and prices will drop more. The other bit, I think one of the interesting comments that Richard made was around recovery in cycles. So this is what's been happening to Sydney prices over the past 10 years. We've clearly had quite a few peaks and troughs in terms of growth. The thing, though, that I really want to point out is that, firstly, downturns haven't typically lasted that long. The biggest downturn we've ever had in Australia, over the past 40 years, was the global financial crisis, when prices fell by 7%. The other thing, though, is that what we can also see very clearly, that is after a period of downturn, we do see a very quick upturn. And the reason that happens is that when prices are going down, we very clearly see that buyers withdraw, and they don't start to pile in again until prices start to recover, and then they pile in very, very quickly. So I guess it's human nature, but I think that the point to make is that once recovery is underway, it is quick, and in many respects now is actually not a bad time to buy. But again, the challenge is people get worried that prices will fall further, and no one wants to buy at a market where it's potentially at peak. Looking across different regions, so it's probably quite small, but what we have found, as I mentioned before, the annual growth rate across different suburbs and across different regions has been stronger in cheaper suburbs. So it has very much been driven by that 5% deposit scheme. So it did allow a lot more first home buyers into the market that otherwise wouldn't have been able to get in, and it really pushed up pricing at those price points at which the first home buyer incentive cut out. Comparatively, though, we have now been seeing quite sustained declines in pricing in more expensive suburbs. So obviously, this part of Sydney is one of the most expensive parts of Sydney. When we have a look at the past 12 months, it has fallen by about 3.2%. So possibly there's more to go, but what has been clear is that downturn that we've seen post-budget was already happening in markets like this, and a lot of it was really driven by the fact that we've seen 3 interest rate hikes. We've got very low consumer sentiment at the moment. We've got the Middle East conflict that's on and off again. All of those things have really played into people's minds and had a flow-on effect to the way people view property. Again, the 5% deposit scheme, I won't talk about this for too long, but it was really a not a very well thought out policy. Obviously very popular with first home buyers to get into the market, but it did lead to this very, very sharp acceleration. I think the irony of this is that the government put the 5% deposit scheme to get more first home buyers in, but really accelerated the market far more quickly than it otherwise would. The budget now tries to balance it out by pulling the investors out. So, you know, overall, they've been inflating the market, and now they're trying to roll it back in. But it clearly did have a really strong inflation impact on pricing in those cheaper suburbs. So, in terms of the forecasts that are out there at the moment, there's a lot of groups that are putting out forecasts. Probably the most bullish has come from, or the most bearish has come from Morgan Stanley. So Morgan Stanley came out quite early and said, we think there'll be a 10% correction in pricing. So obviously 10% sounds a lot. It's it's far higher than any correction that we've ever had in Australia. But I think we do need to put it into perspective. So if we had a 10% correction in Sydney, basically what it would do would take pricing back to about the start of 2024. So a correction in the market which was far higher than we've ever experienced would only take us back to the start of that year. For units, it would take us a bit further back. But I think too to note is that we have had incredible growth over the past 10 years. COVID has obviously been a big factor. But even when interest rates started to increase following COVID, we did continue to see those very, very strong rates of growth. My view, I don't think we'll see a 10% correction. I think, again, when a lot of this uncertainty flows through, I think the impact will be on cheaper, the more affordable part of the market. And overall, I think there's other factors which will really keep pricing elevated, which I'll talk about towards the end of the presentation. When we have a look at listings, right now, we're not really seeing a lot of listings coming to market. So, there's clearly not particularly very big increases in distress. Again, what seems to be happening is that sellers are also watching and waiting and trying to get a gauge on what's happening. We are, however, clearly seeing a decline in the number of properties transacting. So even though listings are remaining fairly flat, buyer activity in particular is impacting on the number of properties selling. So it is clearly having an impact on transaction volumes. The real losers, though, from the budget will be renters. One of the things that is happening with rental listings is they are now at their lowest level since 2017. So when we have a look over, this is over a 10-year time period, but we haven't seen rental listings this low for almost 10 years. And at the same time, Sydney has grown by about 500,000 people. So already we've got a lot of challenges with the number of rental properties available. It is flowing through to rental increases. Obviously for investors, it's not all negative. It does lead to better rental yields, but obviously very challenging for people that are wanting to rent, particularly given the budget will lead to a withdrawal in investor activity, and we do expect that number to continue to fall over coming years. So it's a bit sticky, this. Well, that way. Okay. All right, so then there's rents. So rents have increased $50 a week in Sydney in just 1 month. So it's already flowing through to rental increases. Okay, so now I'm going to talk about the outlook. Obviously, one of the big factors impacting property is interest rates. We do know that Sydney in particular is the most sensitive market to what happens to interest rates. We have had 3 increases this year. We still have a big problem with inflation. So inflation is still sitting at 4%. So it's clearly above the 2 to 3% band that the Reserve Bank aims for. At the moment, markets are pricing in, are pricing in no more increases for this year. So I think the thing to note, though, this can change very, very quickly. If we get a lower than expected inflation rate, this can go down quite quickly. Rising unemployment is another problem. We are starting to see an increase in unemployment. That will also impact the Reserve Bank's decision. Even things like consumer sentiment, they can also impact their decisions. So I think I suppose the thing to think about is that we may or may not see an interest rate hike. I think the thing to really focus on is that cuts for now are looking very, very unlikely. So again, maybe next year, but I wouldn't really count on it in terms of your buying decisions. Population growth is, however, continuing to be really, really strong. So even though interest rate cuts aren't really on the horizon, we still are seeing very, very high demands for housing in Sydney. So you can see there, the yellow line is net overseas migration, the light grey is the natural increase, and then the dark grey is net interstate migration. Very clearly, overseas migration is driving the high levels of housing demand at this point. In Mossman or in the lower North Shore, we are losing people to other parts of Sydney. But there are always people wanting to be here as well. So overall population growth is fairly flat, but of course we're not in a high development area in the same way as Sydney's southwest or Blacktown or Parramatta. In terms of development, we are seeing relatively good levels of housing supply in Sydney. The government is doing all they can to get housing out of the ground. So the unit market in particular is seeing relatively good levels of supply. Houses, though, still very low levels of supply. And then when we have a look at construction costs, as Richard mentioned, they do continue to be very, very high. So this is problematic for inflation. It is a key component of inflation at this point, but the concerning thing is that in 2025, the start of 2025, we did start to see a bit of a pullback in construction costs. They have started to accelerate again. A lot of that has to do with labour. So we do need more trades. The problem when you need more trades, though, is that you need somewhere to house them, and then we don't have the houses. So we do have quite a circular problem in many parts of Australia at the moment, that we just don't have the accommodation to house all the trades that we need to build all the homes that we need. And then when we look at materials costs, that's also a problem, that they have increased as well. So that's not feeding in all that strongly into inflation at this point, but we think it will start to over the coming months. A lot of it has to do with the conflict in the Middle East. So a lot of products are made with oil, plastic piping, for example, paint use oil. We also rely a lot on transport to move building materials around. So all of those things lead to a situation where we do expect an even sharper acceleration in construction costs over the next 12 months. And then finally, the state of the construction industry is still really, really challenging. So not only do we have not enough people to work in construction cost materials are increasing, we also have very high levels of insolvency, and we also have very low levels of productivity. So overall, strong population growth, the cost of building a home is continuing to increase. All of those things will really set a floor as to how far pricing can go. So I guess in summary, the first point, prices are declining in Sydney. We're not quite sure how far they will go, but at the moment, or longer term, we do expect it to hit the cheaper market first. The number of rental properties is falling, so it will lead to greater growth in rents, which as an investor, isn't necessarily all that negative. Construction costs do remain high, so it will continue to be really hard to get buildings out of the ground. And I guess the final point, Australian rental yields are very, very low. People have relied on capital growth to make an investment decision. We do think that they're set to improve, primarily because of that rental growth. So I'm going to finish there. Oh, we've got an Instagram too, so and there's even a QR code. So thank you for having me.
Thanks, Nerida. There's so much in what Nerida talks about as an economist.
Not engineer.
Thank you so much. I think it's very helpful to get a broad strokes and then bring it back to the lower North Shore of what we experience as well. So I'd now like to welcome Stephan Ryan, who is the principal of Edney Ryan, accountants, etc. in Mossman. We've had an association for near 30 years, and he'll try not to put you to sleep as an accountant, but he's pretty good at understanding what's going on. And then we'll have some questions straight afterwards. Thanks, Stephen.
Thanks, Richard. Now, let me see if we can get this to work. Technology.
See?
There's nothing much on this slide anyway. Okay, thank you. Yes, the federal budget for 2026. Well, I don't like to admit it, but I've been studying budgets for near on 4 decades. And it's a part of what we do. We analyse budgets, try to anticipate how they're going to impact on our clients and their affairs. And I've got to say that I think this budget is probably the most transformative one across my professional career. Why I say it's transformative, and that takes in, the introduction of capital gains tax in the mid-80s, the introduction of GST 2000. But this particular budget, I think, is transformative because it's a switch and a focus on the taxation of capital, the returns on capital, and the income on capital. And it's got a long tail, and I think there's a real build into the long term on how impactful that's going to be on investment decisions, on the asset holdings, and on the taxation of those. The 2 things that we're going to talk about here tonight, though, are focused on property investment, and that's negative gearing, big changes there, and also on capital gains tax and how that will impact property. So we'll just under sort of bullet headings, we're breaking down the negative gearing impact on those that have got existing mature properties in your holdings that were held before the federal budget. Basically, there are no changes to that. The only thing that I would say, be very careful if you've got existing properties and you're anticipating transferring those to other entities, refinancing. Be very careful that you don't come unstuck, that the negative gearing provisions that are grandfathered beyond 27, that you don't trip yourself up. So be very careful about that. If you've bought or have bought or will buy before 27 existing established property stock, you'll be able to be negatively geared and through until next June. But beyond there, negative gearing benefits are quarantined against any losses that you've got will be quarantined against gains. If you've got net losses as a result of your property investments, those net losses can be carried forward indefinitely, but they can also be offset against future capital gains on your property investments. So that's the impact of buying existing property now or beyond 27. You won't be able to claim those losses beyond 27 against your other income. It's going to be confined against your property income. New builds. So we've touched on earlier, the government's emphasis is trying to get new housing stock and increase the supply for young people. New builds will enjoy the negative gearing benefit. So that's an incentive for that. However, be very careful, particularly in this market. People might think that you knock down a house and rebuild it. That does not qualify under these new provisions as new stock. That won't give you negative gearing benefits. There's got to be an increase in the actual supply of property for you to enjoy the new build tax concessions for negative gearing. So that means, for example, if you've got an established home, knock it down, put a couple of townies on there, that qualifies. Knock down an existing home and put up a new property, that doesn't qualify. So just a cautionary tale there. Positive news is, particularly for commercial property owners, not impacted by these changes. So if you've got negatively geared commercial property, nothing's changed. The other thing that need to keep in mind is who is impacted. It's just not individuals, it's trusts, it's companies. So it's everybody that's investing in that residential property space. So that's, where's the next one?
Can I just ask a quick question on that?
Yep.
Superannuation funds, everyone?
Yep, same. If residential in a super fund, same thing. Yep, and that's considered just part of the trusts. Yep. Now the next major area that I think this is the really significant one, far more significant than the negative gearing benefits. So properties that were owned before 2027, you will establish a value at 30th of June next year, and the growth on the asset from when you originally acquired it will enjoy the 50% discount. And it will be the growth beyond 27 which will be subject to CPI increases. Now there's a little bit of a revisit to if we go back and have a look at what happened when CGT was first introduced back in 85. The undertaking was that there will only be a taxation of real gains, but things came, rolled along until 1999. And under the Howard government, Peter Costello, they said this is all too complicated. Inflation was a lot higher than it's been in the last, say, 10 years. And every year you would have an inflation adjusted calculation to determine what the profit is that will be taxable on a disposal of a property. They said, that's all too hard. What we'll do, we'll introduce this 50% discount. And so that has survived for the last 25, 26 years. And now that's out and they're going back to where we really started from in 1985. And so for the growth in property values after 27, we're going to go back to 1985, pre-1999, and it will be inflation adjusted growth that will be taxed. If you've got a property that's going to be acquired after July next year, it will be simply CPI increases and you'll be taxed on those CPI increases. Properties that were owned, this I think is quite substantial. Until now, and when capital gains tax was introduced, pre-1985, assets, not just properties, shares, businesses, whatever, were exempt. You were never, and you know, many of you would know, it's always been sort of like a golden egg. We won't disturb an asset that we've had pre-85 because the growth on that is exempt from CGT. That's changed. As of July next year, those assets all come into the pool. And so valuation of assets, properties particularly, I think you'll be well advised to have a close look at the assets that you hold, visit your real estate agents, get advice, and if you've got huge uplift in values, I would think to avoid any challenge from the ATO, it would be even worth your while to have registered valuers with proper valuations on properties at July 27, and the higher those values are at 27, the more you will insulate yourself against the rises that are going to follow, that you're only going to get the benefit of CPI increases beyond that date. So I think that is something that you really should keep in mind. And another subtle thing, but is a real, I think, a sledgehammer, is the minimum tax rate on CGT. And this comes back to how many people have planned their affairs. And it comes back to, say, young people that might be aspiring to buy a house, they've got a share portfolio, they're trying to build their wealth. They're not making a lot of money. They might have tried to put together $100,000 or $150,000, buy and sell a few shares. they're probably paying no more at the moment with a discounted capital gain on those investments, maybe 15% of the gain in tax. After July next year, those gains are going to be taxed at a minimum rate of 30%. We can go to the other spectrum, end of the spectrum, and look at people that may have assets that they would like to dispose of. They might be reaching retirement. They might say, well, look, in 3 or 4 years' time, our incomes are going to drop. Our income might be coming from a tax-free pension out of a super fund. So we're going to delay the sale of these assets until our incomes drop. Well, that no longer is going to work for you, because even if your income is, $50,000 and low taxed, the capital gain that you're going to make after July next year is going to get taxed at 30%. So that is another thing that, as I say, I find this budget very transformative, and I think the tentacles and how it spreads has quite a way to go. And I think in my other just conclusion here on other changes, there are so many things that this budget has almost been by press release. Legislation still light on the ground, and there have been subjects explored, for example, the taxation of discretionary trusts. Initially, the Treasurer said, well, discretionary trusts include testamentary trusts. Now, many of you with your estate planning might have testamentary trusts in your wills for your children and grandchildren. Initially, the Treasurer said, we want to capture those with these more adverse tax points on discretionary trusts. That's been reversed. They reversed some of the small business concessions. So a lot of this stuff is evolving, and I can tell you right now, there's much discussion and debate with accounting and legal and business lobby groups working with Treasury, and there's a long way, I think, to play out before we see legislation on many, many issues, including how they're going to tax small businesses, how they're going to tax discretionary trusts. There's even a live debate at the moment where Treasury sort of made out that they were being big fellows and will give you a rollover period to move assets out of those entities that we are trying to discourage you to have assets held in, discretionary trusts. There'll be rollover provisions, no CGT. Now, the only problem about that is that's the federal government talking, but what's the stamp duty consequence going to be at a state level? And so there's quite a debate in the background going on as well. Hang on a minute, if there's all this restructuring is going to occur, how many hundreds of thousands or more might people be incurring in stamp duty to realign their affairs the way the feds would like them to look? So, as I say, I think this is a budget with a lot in it. I think it's very transformative. If I could give you a warning or some advice, hasten very slowly. Anybody that's making suggestions as to realign and rearrange your affairs at this stage, I think, is way, way premature. And I think you hasten slowly and get good advice. So,
thank you, Stephen. It's an interesting comment that the government is light on detail now, but let's see what happens. So I'd like to throw it over. There's going to be questions in the room, I hope. Happy to answer from Nerida, Stephen or myself. Any questions you've got, anything you'd like to discuss, happy to have that discussion. I haven't set anyone up to ask questions, so it's okay. Don't all, yes.
Do you think the government changed the capital gains tax rules because from now on they're going to provide housing for people to rent? Because I'm not going to do it anymore.
Exactly, and I think that in understanding that, in my belief, the investor in the market is the best person to supply housing for the people. The government can't do that. And the investor is happy to take a 2% return on their money as long as they've got capital growth. So in fairness, I think what you're talking about there is why would you do it? And you've done it for many years around this area supplying housing for people, and it becomes very difficult.
Well, you're supplying it, if you're lucky, 1.5%, 2%.
Yep.
And if you make a gain at the end, fine. But if they take that away, they can do it.
Exactly.
You know, and
There's a country called New Zealand where there's no stamp duty or capital gains or anything else. But again, that's the Wild West, someone told me once. Yeah, and they're good rugby players. Any other questions? Yes. Sorry.
Sorry.
Yeah.
Question for Stephen. So the implication here is that if you own a property and you might want to sell it in the future, you should get it valued as of July 27.
Mm-hmm.
So how does that work in practice? Because obviously it's in your interest to value it as highly as you can, and then,
Yes.
then there's going to be a debate with the tax department.
No, that's my point. I mean, if you've got a robust valuation, I'd suggest that it be supported by a registered valuation, have a valuation that will then stand pressure from the ATO.
Oh.
Yeah.
And I think that's going to be another interesting conundrum within the market. How many valuers are in the market right now to actually value all these properties? And what we do now in a lot of estates, in a lot of different areas for probate, different things, is we will give market opinions.
Yep.
And Stephen and I discussed this earlier today, is us as real estate agents on the ground in the area, the valuers ring us when they do a valuation and go, how much is this?
Yep.
So they're going to have to come up with some sort of formula, which I don't think they've given a lot of thought to, because as of the 1st of July next year, every valuer in Sydney, Australia, will be out of control.
Yeah.
So we're talking about it saying, will a market opinion suffice the tax department?
Yeah.
Sorry, madam.
That's okay. I was actually going to ask exactly the same thing about valuation, because it seems as though there's going to be a shortage of valuers.
Yeah.
There's going to be a lot of people looking for values. We know that when a bank is looking to value a property, it's incredibly conservative.
Yes.
And that would actually go against the property investor.
And
And then as a lot of desktop valuations are done. So, I was just going to ask if anyone had any ideas.
I think also they're going to utilise AVMs as well, so automatic valuations. I think that's one of the strategies. But again, it's light on detail, because will they accept that at tax time? I don't know, but that's what we've heard.
If it were me, and I want a defence file for the ATO, and it doesn't have to be done bang on 1st of July next year. You'll have a period that a valuer will be able to make an informed view of your property, and it might be over the next year or so. But if you're thinking about selling it, and you've got you want the optimal outcome, I wouldn't be relying on some online valuation. I certainly wouldn't be asking the bank's valuer, and I would pay the price and seek advice from your agents to get a ballpark as to where it is. But if you want watertight guarantee that it will stand the ATO scrutiny, pay for the valuation. That'd be my advice. Yep.
which, what we're experiencing with valuers at the moment, with 100% respect, I think they do a great job in this area, but they are so busy, and the restrictions and the compliance around what their valuations look like now from insurance purposes are out of control as well. So because people are relying on all these valuations all the time, we're seeing it every which way that I don't know where they're going to get the time to do all of these valuations.
Yep.
So
Yep.
the ATO, stamp duty is going to be a big one, because that's state government.
Yep.
So the cost of transacting, the idea, I believe, of what we would call flipping properties, people who are buying an investment, renovating it, enjoying it, and then flipping it within a 12 months to 2 year period, is probably well gone.
Yeah, we had this discussion. I think when you think about strategy and the impact on clients and how they might change the way they do business, I look at it this way. If you've made good money on a property transaction, what you'd be better off to do going forward would be use the built capital and the increased value in the property to trade yourself into another one, but keep the original one. So the process of turning properties over and having that tax drain. To build your wealth, you'd be better off to retain it and try and compound your growth by not disposing of your properties. That'd be how so I think that'll be one reason that might slow the amount of turnover in markets, so.
Yes.
Do you think the ban on limited recourse borrowing with super funds will have any impact on that?
I think virtually nil. I mean, it's almost been impossible to get borrowing through super funds in the last 8 to 10 years anyway. And I just don't think that it's such an infinitesimally small part of the market, and I think that's going to even get harder. So gearing within funds with residential properties in them, you see very, very little of it anymore. We see gearing of commercial properties in funds. That's not part of the remit here. And the reason you see more commercial properties in there, typically because the yields are higher, so they can fund a bit of debt. But residential yields are so low, it's almost impossible, other than to put 70% of the capital in the fund, 70% of the value of the property of the fund, towards the purchase price, and very little borrowing level. So I don't see non-recourse borrowings in the fund.
Yeah, it's around 4,000 per annum, so it is quite small.
Yeah.
The developers aren't happy, so one of the issues is that a lot of projects get up and running through that method. But so they've been quite active in Canberra trying to.
Well, they need to develop it. They need the developers
Bragg
to continue to build these houses, but
yeah. So I think even though it's a small number, but it does flow through because they can't get pre-commitments. So.
And there's got to be the buyers. In this area, it's going to be a more difficult situation.
Probably doesn't
because
happen
land prices are so high, construction costs are so high.
Yeah.
From a developer point of view, to make a feasibility work right now is extremely difficult. So that's going to be impacted. Madam. Yep.
It's a question.
Sorry. Yep.
Regarding we're talking about housing, but what about shares? Because if there's going to be a change in the regime, the 1st of July next year means that people actually then reassess the value of their share portfolio, and you might very well get an escalation of share values up until that point, because that's the next stage. You get a tax kicking in, which would, I don't know how that would work, but presuming the one on capital, if you've got a 30% tax regime, at that point, that changes the valuation of the share markets.
It could do, yeah. We'll have to see how that plays out. But yeah, you tend to think that these changes are just affecting property, but they're affecting every capital growth asset. Yeah.
Yes, madam.
As at the moment, I understand that there's not a capital gains tax on non-residents. Do you have a feeling as to whether that is likely to slide?
Oh, golly, I think that, geez, I'm a game man to say it, but I think that is such a holy cow in Australia. I think you'll find there's going to be a huge kickback as a result of these changes already. If they went the next step and said we'll tax capital growth on principal place of residence, I think it's part of the cornerstone of our society. I don't think that would really cut the mustard.
I think we're more likely to move from the bigger risk is we'll move from stamp duty to land tax, and that's happened in Canberra now. So Canberra's now moving to a land tax, so you're paying a much higher rate per annum. So
On your principal residence?
On your principal residence. So I think that's more likely, but then CGT on.
So there's I think also what Stephen would have said as well is all of these things could change again in a next election, which can bring more uncertainty. We need more stability in the property market, which we enjoy the ups and downs. This is the COVID, everything else, financial crisis. I was there paying 20% in the early 90s and enjoyed it. We've had very low rates for a very long time. So we've got to deal within the market, and we've got to understand that we are in a market that's going to be fluctuating, whereas most people have been, the Sydney property market has been resilient for 30 years now, and everyone thinks it only goes one way. But we are in a downturn.
Yeah.
So, any other questions? Yep.
It seems that there's a lot of uncertainty and unknown. What is the best way to go?
Depending, that's a hard question for me to answer, because it depends where your assets and your wealth creation plan is. Whether you're dealing within your super funds, whether you're dealing within family trusts, whether if I was a young person right now, and 30 years ago my learned accountant here said, buy the biggest house you can possibly buy. Spend as much money as you can possibly spend, and keep building your wealth within your principal residence, because it's your best tax haven. That's what I did with my family, but it also has been a great investment for many years. So depending how you look at your own investments, I think you've got to get your advice on what you do. But at the moment, I think there has been a very sharp downturn that we weren't really expecting in December last year. The talk was interest rates will be cut in February, and they went up. And they've gone up twice since then. A war, stock market strong. We are fueled by, as I said, the stock market and the big companies who buy our properties. So it's a hard one to answer which way you would jump right now, but principal residence is your tax-free haven right now. Sorry?
Changed it at the current moment.
Yeah.
Right.
Well,
we have a interesting situation that no legislation has been passed.
that's correct.
Right. We also have a situation where the government, God help us, is throwing a lot of spanners in the works for productivity and national growth.
Mm-hmm.
We also have a situation where they're now talking about death duty on your prime residence, right? And now they're also talking about hacking into your trusts when you die, and taking money out of that where your dependents are going to pay the bill.
So as I've said to my children, work really hard at school, go to university, work really hard, and then work in life to make all the money so you can give it back to the government to redistribute to the people who didn't do it. Yeah. So in fairness, we're not here to beat up the government, we're here to look at the market. And
I understand that, but these are the things that are throwing
that's
at us,
yes,
who are trying to, be financially...
that have played between the rules and done what we were supposed to do.
Yeah, and now it's all been thrown into the mixing bowl.
So
I don't know where it's going.
I think just on that point, and it's what I touched on, they have stepped back on I think what you're referring to are testamentary trusts within your will and with your estate plan. They've distinguished those from discretionary trusts. So that was one positive. That's.
Well, as I said, they still haven't put anything to pay.
Oh, I get that.
yeah,
Yeah.
Yeah.
And
but they got the numbers.
oh yeah, but problem is, as a developer, right? You were supposed to return 20% on your investment, right? As an earmark to when you go and do a development, right? That was back in when I used to be a youngster. Okay.
Well,
Now I don't know what they're going to do, because where do they get there's three things. Where do they get the land to build the 2%, first buyer homes?
Yep.
Where do they get the people to build them? Where do they get the material to build them? And the government, at the New South Wales government, they can't even get 70,000 homes up
No.
on the land. So, we're
So let the investor, as the gentleman at the start said, own the properties, take his 2% return, get his capital gain, and supply housing, because the government can't do it.
well,
Look at the Build the School thing. Anyway, let's not get into government because you'll start me on something that's not good for me.
I just want to ask one more question.
Yes,
You were referencing when you were young,
yes.
so I think we did what.
I'm still young. No.
Well, yeah, I mean, what happened when, I'm 71, so it's much.
You don't
much
look that
older
at all.
than you are.
No. So, but as young, I've been a real estate agent since 1986. So I'm been around long enough to understand what goes up and comes down and looks at and built businesses, and we employ near 100 people in our business here. So we've got a very diverse business, so we see a lot of different things that happen. We get to see what's happening on the ground, and I think growing through the real estate market, you see all of these things, but it's so resilient, it seems to bounce back. It just, there's so much money invested, which is what I look at. There's so many people who've got so much money invested in their own homes. If you're not under pressure to sell, you just don't sell. So therefore, what the government's doing is we will start to see, I think, as much as there is quite a few properties that will come on the market. And in my mind, we work on 3 Ds, and it's called divorce, death, and the bank. They're the 3 reasons why people sell, right? And so therefore, if those 3 reasons are there, people will sell. So we do a lot of estates, we do a lot of divorces, we do a lot of the bank work. But you don't see the bank work anymore like in the 90s. You never see mortgagee sales anymore. It is worked out behind the scenes, and the bank doesn't want to take over possession any further. They don't want to be part and seen as the bad guys anymore. So we don't see a lot of that around these areas, but the other 2, yes, because it's a long generational market that we work in here. Mossman, the Lower North Shore, most people have been here for a long, long time, and they're invested, and they have a lot of their wealth creation is right here. So to have the ability to have Nerida and Stephan talk about what's happening in Australia, but really focused here, what's happening with the budget, I seriously hope it's helped you. If you'd like to talk further, we're always here. I know a lot of the faces in the room.
So can I assume that if I have done what you have done,
Yep.
we don't have to do much, is that right?
Well, we can't change it because the government was voted in.
Yeah.
That's the problem. You go to Victoria, it's a hell of a lot worse down there. And just touching on what Nerida said, for some reason the Gold Coast's gone out of control. That's because all the Victorians are moving up there. Yeah. They've been taxed, they've been locked into their houses through COVID. They just keep getting taxed. They have a holiday house. If they don't go and stay in it, they've got to pay a tax over and above their land tax. So I think we're pretty lucky where we live. I enjoy it. I think the Lower North Shore's a pretty special spot. So we can't walk around being negative about it. We've just got to move on. So thank you all. I hope that's been informative. Thanks for all coming. Thanks to Stephan and Nerida.
Pleasure.
Thank you.